what is Trustline's house view on the current market setting?
If you go back by 6 months and look at this scenario, everyone wanted a correction. Experts on the TV panel were echoing a view that if markets were to correct by about 10%, then the investors should be ready with their shopping bags and they should go on a shopping spree. Here we are with a very sharp correction in the broader markets. Experts have changed their tunes and shoppers are on scoot and run mode. Corrections don't happen in isolation. They always happen with the amplified narrative. Also, corrections don't happen in a very orderly and smooth fashion. It's always disorderly. The ongoing correction is no different. The screens are very scary and gut-wrenching, and it's extremely disorderly. Much of the narratives that are accompanying these corrections may not hold in the medium term, and they are far from on-ground realities. But that's the way it always happens. That's the nature of the beast. Another interesting way to look at this correction is look at how times have changed. Last year, investors were wondering what can stop this one-way bull run. Now investors are so desperate that what can stop the slide and what can stop this massive FI sell. Last year, every correction was a buying opportunity. This year, any bounce or rally is a window to exit. So markets have changed from buy on dips to sell on rallies. Last year, you first buy and then investigate. This year, the scenario is you first sell and then check. So things have dramatically changed in the last 1 year. Coming back to the genesis of this correction, it all started in the month of September when the China reallocation trade got triggered. So initially FI started selling India and then started moving money into China. And that kind of upset our markets in the month of September. But that reallocation trade, when it got fizzled out in October, our market stabilized a bit. FIs came back in October. But since November, things have been completely different for India. The so-called Trump trade started sometime in November with the US dollar index strengthening and US yield going up. As a result, money started moving from emerging markets to US, and India was no exception. FI started moving money heavily out of India. This is one of the reasons that caused a huge correction till December. And the entire EM basket corrected at that period. But what's happening from Jan is a bit of an isolation for India. Emerging markets have started inching back with dollar kind of stabilizing and US yield little bit, US yield kind of softening a little bit. But India is still bleeding. There's been a massive FI's outflow even in the month of Jan and February. In this calendar year, close to over 100,000 crore has gone out in terms of FI outflows. That kind of massive, if you look at the FI numbers since October, it's over $25 billion plus in secondary market sales. That kind of massive outflows we have not seen for a long time. And that has kind of broke the back for the market sentiments. Complete fear has gripped the markets. There is no reason or rational or logic works in this market. Fear of further fall is good enough reason for investors to sell and run. So it's, the momentum on the downside is extremely high and with signs of capitulation in the markets. In this kind of, just to give you the numbers, just to give a sense on the numbers, BSE small cap index at the index level has fallen by over 20% in this calendar year, starting from Jan 1st. And if you look at the broader stock level fall, there are many stocks which have fallen by over 50-60%. That's the extent of correction in this market. So it will be futile to look at reasons for this market. Right now, investors should wait for the fear cycle to play out. Any attempt to find a reason will take you nowhere but dead end. That's where we are. That's the current market setting. In the short term, it's going to be brutally volatile until the bad blood is out from the markets.
What will stop the market slide, and when will the relentless FI selling stop?
The honest answer is no one knows. No one knows when FIs will come back, when these markets will start recovering. We should leave that to the market's wisdom. But what we can do is we can look at some of the pointers that can probably help us to look at some of the broader timelines in which the markets can come back. So let's look at some of the pointers which currently the market is ignoring because of the panic and fear in the market sentiment. The first is the consensus trade on US exceptionalism is slowly fizzling out. The momentum for that particular consensus trade is slowly losing its grip. Slowly money has started moving into underperforming markets globally. So if you look at Europe, if you look at China, if you look at the rest of the EM markets, one has started seeing signs of money coming back. Europe broader index is up by about 8 to 9% in this calendar year after very, very long underperformance. And China hangs, if you look at Chinese markets through Hang Seng Index, it's up by over about 17-18% in this calendar year. US markets are just up by about 3% this year. That tells you that consensus trade is slowly losing or slowly fizzling out. That's one. Second, the money is slowly started moving into EM markets, which may not be the case for India, but EM as a basket, the inflow has started, and the EM markets are slowly inching back with signs of stability in the dollar and signs of stability in the USD. While all this is happening, things are improving on the ground for India. India went through a huge slowdown starting from June for various reasons. Now one slowly started seeing from end of December to now, the high frequency indicators are indicating there could be a recovery on the ground. Be it any of those signs in terms of government capex or the truck rental rates, which have gone up by about 3% in the month of Jan, or the GST collections, or any other high frequency indicators, they're all pointing to some level of recovery in the ground, some level of recovery on the ground. Even if you go by management commentary of infra players, they're all now slowly turning bullish in terms of on-ground activities picking up for infrastructure as well as for capital investments. And the more important thing to understand and note is that slowly base effect of slow growth which happened in June will start optically lifting growth for corporate earnings and for GDP starting from June quarter this year. So if you put all these together, and if you go by our earlier experience and previous experience in the past cycles, it's very likely that markets will start discounting this turnaround at least few months in advance, 2-3 months in advance. So if we assume that the recovery is going to play out on corporate earnings from June quarter, probably a few months earlier the markets will start discounting. If you go by that, probably the pain will be there till the end of financial year. It's very, very unlikely that you will have pains extending beyond that. But in this market, the caveat is anything can happen and nothing can be ruled out.
What should investors do in this market mayhem?
This is a very important question. This is where I think one should focus on more than the commentary on the current market setting, what could turn the markets. I think what's very, very important is what investors should do and how should they deal with this correction. Should they just sit tight, or should they just take no action, or should they freeze into kind of no action because of the panic and fear, or should they use this opportunity, the correction, to build their portfolio, add to their weights, and pick stocks selectively in the broader markets, which has got a lot of tailwinds in terms of fundamentals. And which options they choose is going to determine the real long-term alpha creation in their portfolio. It's not time for panic. It's not time for listening to narratives and the media noise. It's time to ignore the noise, tune out the noise, and then focus on portfolio building on a stock specific and bottom-up manner, and with a very, very selective approach in the broader markets. So in summary, key to surviving this very brutally volatile market is to tune out the noise. Of course, it's very hard to do when there's so much of when you are getting bombarded with media narratives to do the opposite. But successful investors don't fall into the trap. They focus on the long term, stay disciplined, and avoid trying to time the markets. That's how you can help, to enhancing your compounding without falling into the pitfalls which derail many of the investors. These are very, very interesting times. Thank you.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.